not going to be able to save your way to buying properties. You're going to need investors,
Yep.
and you got to be credible. Property management, I did. I know. I see the look on your face.
Yeah.
But if you're,
it's my least favorite thing about properties. Hey everyone, welcome back to the Mark Loeffler Experience. We got Kyle Ford from Cap Mortgage Trust with us today. We're going to be talking private mortgages, short-term rentals. We're going to be talking development, how you're going to get your first property at 22 years old, how you're going to buy properties at 50. Guys, you don't want to miss this. This is jam-packed. Enjoy, everyone. All right, Kyle Ford, buddy, welcome.
Thanks, Mark. Thanks for having me.
So I guess the reason, well, obviously you're a mortgage broker, you're a developer, you're a short-term rental specialist. You're still managing your own short-term rentals, correct?
Yeah, we've created a business that does that. My wife runs it, but yes.
Yeah,
yes.
So it's in-house.
Yes.
Do you do it for other people too?
No. We have to own the properties to.
It's in-house.
Yeah.
Okay. So what's the evolution of Kyle been? So Kyle started off as a mortgage broker. Were you a mortgage broker first or investor?
No. So I started off as a financial advisor.
Okay.
So very traditional financial planning approach. Pay down your house, money in RSPs, save for a rainy day. Started kind of checking out real estate.
So you were a little brainwashed when you were younger.
Very much so. Yeah.
Okay.
Yeah, very much so. But it kind of peeled back the curtain for me because as an independent financial advisor, I got to see a lot of people that I thought were doing really well financially. I got to see behind the curtain for them.
Yeah.
And I really wasn't happy with what I saw in my definition of success. And I noticed the only thing that they really had that was impressive was the real estate. So started dabbling more and looking into more of the real estate side of things. And then eventually evolved that way.
So, okay, when you talk about that, you moved from financial advisor. So did you start investing in real estate yourself?
Yes. Yeah. So started small. So pre-construction condo, single family rental. After that, I went to one of those HGTV star coming to your town, check out real estate event, which I did learn from.
Yeah.
And I got into multifamily real estate. So small stuff, triplexes, duplexes, and slowly just went up from there. Ended up getting my first cottage, started dabbling in the short-term rentals, then bigger multifamilies. So really that natural progression from a single family unit to a very small multi to larger multis. I got into the cottage side of the business because I was struggling to find good yield on multifamily.
Yeah.
So I more of an active business approach with short-term rentals.
Yeah. Good stuff. Okay. So when did you become a mortgage broker?
So interesting timing, a pretty significant date actually, January 1st, 2018.
Okay.
And the reason why that's a significant date, I'm going to test your memory a little bit. That's when the stress test came out. So,
well, they didn't come out till April, though.
So they initially launched it in January and said it was coming.
Yeah.
So when a lot of mortgage brokers were actually, frustrated with the industry and turning away from the industry, I was going at it head on. And one of the strategic advantages I had at that point is a lot of previous brokers like to talk about their clients about what they could do before the stress test. Well, I didn't know any better. I only knew what I could do with the stress test.
Yeah.
So I was able to take a fairly significant market share right away with, a little bit more of a fresh, ambitious approach.
Well, you were also an investor, right?
That's right.
So, you understood the investment side. I know when I got into real estate, I took clients off people because they're like, "Oh, we want to work with you, Mark." I'm like, "Why?" And they're like, "Well, because you know the numbers." And I'm like, "Yeah, well, the numbers are easy. That's why we want to work with you." And these other guys don't know the numbers, and I'd never even thought about that. I didn't think about the frustrations I had trying to find a real estate agent or a mortgage broker that actually understood investments and understood the numbers. And then I look back and go, yeah, well, I looked at 100 properties with one guy and I bought one house. There's no way I needed to look at 100 properties. Maybe should have looked at 10.
Agreed.
Yeah.
Agreed. When you're in the investment space, it comes naturally, and you sometimes forget that that's not the norm for other professionals.
Yeah.
So.
Yeah. So you owned a bunch of properties when you became a mortgage agent.
Yeah.
Okay. And because I know you have a significant private lending portfolio. That's really where I thought we were going to go for at the beginning, but I don't know, maybe not. But so private lending. Let's talk private lending for a second.
Yeah. So I'll talk a little bit about, I guess, how I got into private lending. It was around that same time. My wife at the time now, we bought our first she bought our first house together, which was a flip, and she bought it prior to 2018, before the stress test, and she qualified for the mortgage. When we sold that property in the new year, we went to port her mortgage somewhere, and she didn't qualify anymore. So she was quite upset, in tears. What am I going to do? And I was like, I think I got a guy, it was my lawyer at the time, who had told me, if you need private money, let me know.
Yep.
So that was my first private loan. Borrowed a deal at 10% and thought that was crazy.
Yeah.
How are people making money?
Now it's free.
Now it's free. Now you're lucky to get that at a bank.
Yeah.
That's kind of how I got into the private lending side. From there, that same lawyer who I did a couple deals with called me one day and said, why don't you start telling your clients that you have private money available? And I was like, well, do I? And he said, yeah, you do. So send me the deals and I'll fund more deals. And it really is amazing to see what happens when you start telling people you have capital available, how your phone starts ringing.
Yeah, because I called you about that.
Yep.
You told me you couldn't help me because I was in Alberta.
What
a mistake you made there.
Hopefully in the next year or two I can help you out west.
Yeah.
So it really did grow and scale, and we are doing we have a 9+ figure book right now on private money, out on active mortgages, and it started off with a $300,000 loan, and then a $500,000 loan, and one thing led to another, and here we are today. So.
Nice. Well, you get the 9 figures pretty quick at those numbers, right? Like you just said, there's $1 million in loans right away. You don't have to do many of those, and with values the way they are, if you're lending first mortgages, it's not like a $40,000 second mortgage or nothing.
That's right. Our average loan size is about $1 million now, so it's 100 loans.
Yeah.
Right.
Yeah. Which is significant, but not massive.
Right.
Yeah. All right. So, well, let's just get into if I wanted to borrow money today, what's my cost to borrow money today?
Average yield right now, total between rate and fees in the private market, is about 15%.
So now, are you running that through a MIC, or is it just like I come to you, I got $1 million, Kyle, I want to go lend that?
Yeah, so great question. We have it's called the direct lending model. That's where if Mark's the lender, Mark's name is registered on title as the mortgagor.
Yep.
Or mortgagee, pardon me. And we also have our private fund, which is not a MIC by definition.
Okay.
It's a mutual fund trust.
Yeah.
But it operates very much like a MIC, where we're only lending on mortgages. The main difference, and we went very deep down the MIC rabbit hole, what a lot of people don't know is MICs are capped at 50% commercial on their books.
Yeah.
And a 5-plex is considered commercial.
Well, it depends which bank, but yeah.
The regulator who regulates MICs deems it commercial.
Okay.
So that's why we did not go the MIC route. In our book, on our mortgage trust cap, if we could lend 100% of the money on apartment buildings, we would.
Yeah.
We believe that's a great spot to secure our assets.
Well,
to.
Banks think they're the least riskiest asset right now, right? So why wouldn't anybody else?
Yeah, we had loans that we did at the peak of the market in 2022 that we were at 85 to 90% on acquisition. Those loans are being paid out now 14 to 16 months later, we're only at 55% loan to value.
Yeah.
So when the market's been declining, these were value add apartment buildings
Yep.
that have seen significant lift over the course of a declining market. So that's a great spot to secure client money too.
So, let's talk Alberta. I just locked up an 84 unit, just over 10 million. Need $3 million for renos, but my end value is 18 million.
If you had a different postal code, that would be really, really helpful. So I'm currently not licensed to lend privately in Alberta. If there's assets,
what do you have to be licensed for?
So there's from the broker perspective and the fund compliance perspective. So there's securities filings. There's.
But you wouldn't lend me 100% anyways.
No. So we are very aggressive on LTV on acquisitions for value add apartment building.
Yeah.
Our underwriting is at 85% still on acquisition.
Super high.
Which is aggressive.
Yeah.
It's got to be value add though.
Oh.
There needs to be a lift there. There needs to be.
Here's the thing why you should be in Alberta. I'm selling you now. Is because I got 22 units vacant. I can go raise the rents on the rest of them anyways. So my 22 units are going to get filled from within the building after we figure out who we like and who we want to keep. They're going to move into the new ones. I get those 22 units, plus I've just raised the rent to market on everybody else anyways, on the new market rent.
Yeah. It's why we're very bullish on Alberta. It's just, in the growth of all of my businesses, what I'm focused on right now is bandwidth. And I want to make sure we're digging deep holes in the markets that we are, as opposed to going wide.
Fair.
So it is certainly on my radar. I'm going to skip.
I want to help you get to 10 figures.
I want to go there with you.
Yeah. Private lending, obviously you got a massive private lending business. You have the mutual fund trust set up for that. So for anybody who doesn't know what a mutual fund trust is, basically you can invest your RSPs, you can invest TFSAs, or just cash or corporate funds into that. And you're probably paying a return per month, I'm assuming, because that's usually what they do, 6, 7, 8%.
We actually have 3 tiers. We're 8, 11, and 14.
Okay.
So our 14% is construction financing.
Yep.
It's very, very aggressive loan to value stuff. But there's massive demand for construction financing in today's market.
100%, yeah.
So that generally our borrowers are just taking that for the short term, just to bridge some construction costs.
Yeah, good. Any concerns about now you have to be a CMHC lender to be able to get paid out by CMHC on the takeouts, or?
Yeah. So my belief right now is what I'm seeing in most deals is most borrowers need to almost do a 3-tier structure.
Yeah.
So CMHC is the holy grail of hold financing.
Yep.
When you're done and you're
50-year amortization, 95%.
Holy grail. Everybody wants it. The challenge is getting there.
Yeah.
And what you mentioned is the approved lenders. A lot of those are B-type lenders right now.
So Pinnacle.
Yep, Equitable Bank.
Peak Hill.
Peak Hill, Equitable Bank is a big one right now. They're taking a ton of market share.
Yeah.
So
they lend through Harbor.
There is some affiliation there.
Yeah. But Harbor's not accredited, so if it says Harbor, doesn't matter.
You got to get it done on different paper.
Yeah. So but Harbor's trying to get accredited.
Yes. So what the challenge is, even with those Peak Hill B-type lenders, they're not as aggressive as the private market.
No.
So where we see gap,
but
the
capital, 9%.
Yeah, we see the capital gap in the market where we can be your acquisition money to get you in on aggressive terms to start turning the building over.
Yeah.
As you're stabilizing, you go into bridge financing with one of those alternative type lenders, and then you sit there until CMHC picks you up out of their 8-month pile and gets you your hold financing long term. So if you could do a deal by skipping that first step, fantastic. Like we still have a brokerage. We're still a broker. We're happy to broker that deal in the beginning.
Yeah.
But a lot of the times what our clients are saying to us is, it requires more capital to use that bridge financing. We would rather pay a little bit higher rates with you to put less money down to get into the deal.
Well, that's what I'm saying. Let's get to Alberta. Jeez, stop being so lazy.
Yeah, no, I don't have much else going on. So.
Yeah, fair. All right, let's talk about what else you got going on. You have a development business too. So you buy raw land and you develop stuff.
Yeah, so we've done a couple different levels of that. So I've partnered with a partner on some pretty major stuff here in Hamilton, Ancaster area.
Yeah, I know, I like it.
Yeah, so our plan on those deals, and a lot of those deals we've actually flipped out at SPA. So we've gone through the entitlement process,
which is
site plan approval. Sorry.
Yeah, everyone doesn't know the acronyms.
Yeah,
right?
yeah. Sorry, site plan approval. So like the one deal we did in Ancaster, we didn't even get site plan approval, and we have a massive lift on the property that it just makes sense to sell now.
Yeah.
So I've also done a ton of small scale development as well, like severances. So that's for some of the more, I don't want to say newbie investors, even just like mid-tier investors, the small severance plays where you can slice off a lot and it doesn't actually devalue your main asset.
Yeah.
You can make a $400,000 or $500,000 lift slicing off a lot, and your initial asset doesn't go down.
And it's basically free because other than the cost to actually sever it, it's already built into the cost of your asset.
The other cool thing about it too is now you have a free unencumbered piece of land, which means if you want to build a small multi, it's easier to get construction financing because it's unencumbered.
Yeah.
You have a free and clear land value. So we've done very, very well on those. So the smaller scale ones.
So what areas have you done those in?
So that has predominantly been in Grand Bend.
Okay.
So Grand Bend, Ontario is a beach town on Ontario's west coast, if you will.
West Coast.
So and we've done some luxe builds. So there are 3-story, 3,400 square foot luxury homes in cottage country.
Okay, so what do you look for specifically when you're going for those types of things to look that you can see to sever off for lots?
Yeah, so corner lots is a big one. Can you twist and sever? So the house might be facing the north road, but it's on a corner. If you turn it sideways, you may be able to get 2 lots facing the west.
So you're going to tear down the one house?
Tear down. So I've done that, which is a tear down and twist.
Yeah.
I've also done sever off. So there was one that had an overhang and a garage. All we had to do was tear down the garage, pull back the overhang, and we had a full lot sitting there. So in that market, there was actually some sites that had original pins on the other lot. So the severances were very, very easy. It wasn't that much of a long process. There was actually a pin that represented that being its own parcel at one point.
Yeah, a pin is just, for everyone watching, is just that it was a separate lot at some point. The land values were so low that people just picked these up for probably nothing to have a bigger backyard or to build a garage or something like that. And now, obviously, land values in Ontario have gone. So it's smart guys like you are coming in and saying, oh, I recognize that. There's 2 separate pins. Like, we can do something there.
Exactly.
It's funny, though. Like, so in Hawkesbury, Ontario, way back when, there was a builder building side-by-side duplexes. So, duplex, 2 separate municipal addresses, separate pins. And I was buying these guys off these guys as fourplexes. So I was buying them for $300,000 as a fourplex back then. And I was basically flipping them out without doing anything, just separating the pins for like $225 each. So I was getting them for $300,000 and flipping them out for $450.
Amazing.
Yeah.
And you think everyone knows this stuff, but like a builder had no idea. They didn't know that was the value. So
yeah, and he loved selling to me because I'd buy everything he could do, and they cash flowed like you wouldn't believe. So if I held them for a year or year and a half, I didn't care.
Right.
Yeah.
Amazing.
Yeah. So small scale development, look for corner lots, double pins. Obviously, you know Grand Bend very well. So if you guys are looking and doing those things, become an expert in the area.
Yeah.
I know my buddy Charles. You know Charles Waugh?
Definitely heard of him, yeah.
Yeah. So he's done this a bunch in St. Catharines where he has a corner lot and he gets 1 or 2 lots off on the back side because they were super long and 40 foot or 50 foot wide or whatever. You can do this pretty much anywhere.
Yeah, I'll give you another cool one that we actually just got approved on, and a lot of people don't know this. This is more for larger estate type properties. We bought a 14-acre property, and there was a very, very large 7,200 square foot home on it.
Okay.
What a lot of people don't understand is when a bank comes to appraise that property, they account for the house plus 5 acres.
Okay.
The additional 9 acres weren't factored at all into the appraisal.
Yep.
So what we were able to do is actually sever them off into 3 more estate lots, and that land value on those equated to about $1 million, a little over $1 million actually, and the value of the house didn't change.
Yeah.
There was no adjustment to the value of the house after the parcels were severed off. So that was another way that we could find value where everyone else was looking at it as, oh, the house just seems like a big house that's kind of overpriced. And I said, well, it's not that bad if you slice all that land off.
Yeah.
So
are you living in that 7,200 square foot house now?
that was my COVID retreat.
Yes,
so it had an indoor pool. It had a lot of stuff. So when we were all locked down, we moved out into the boonies at this house and kind of hung out and swam and in the middle of the winter, rode around our toys. So we're likely going to sell the property now. It's just being the severances were just approved, and the renovations on the starter castle, which is the house,
castle
are almost done. So
nice. So you do all these things. What else does Kyle Ford do?
Well, so I guess on the real estate side of things, I've kind of really pivoted back. I kind of got away from the larger multis for a while. I'll admit to having maybe a little bit of shiny object syndrome, chasing some of the latest buzzwords and
Short-term rentals.
Well,
You're in Grand Bend too, right?
Yeah.
So it's a big market for it.
Yeah. So we did do a boutique hotel as well. So we
nice.
kind of like that model better than the short-term rentals because you have commercial zoning, less restrictions, less downside when government regulation gets involved.
Yep.
But I've really kind of gone back to my grassroots right now, which is value-add multifamily. So we have 3 buildings in Kitchener going right now that we're doing large turnover on. We're actually, a lot of them are large 2-bedroom units. Yeah. We're turning them into 2 ones or 1 and a bachelor. So without actually increasing the footprint, we're adding a lot more units.
Yep.
So as we've seen the market shifts, as we've seen things happen, I'm really appreciating the risk side of things more and sleeping at night more. I have a 3.5-year-old, another one on the way. Like I don't want to be stressed out about all these multiple.
You want to be sleeping at night, not sleeping at night because they're keeping you up.
That's
rather
right.
Than
I got enough reasons to not sleep at night. I don't need my investments keeping me up too. So so we're really kind of getting back to that multifamily. It's funny, Chelsea and I were. She hadn't seen the one building that I was looking to buy. And she's a designer, and we have some luxe new builds going on, some beautiful homes. And I take her to this 8-plex that's gutted and moldy and everything. And she's like, it just feels right. Like it just feels right. Like these, I
thought that was going to go a different way.
Yeah, no. She said, she's like, I love doing the pretty stuff, but this is what we're good at. This is where I'm comfortable, and this is what I can. She's like, as our family's growing, she's like, when I do design choices for the 8-plex, I can go in once.
Yep.
And it's times 8, times 8, times 8, times 8. Not all these custom new builds where she's got to. There's a lot of brain power that goes into designing these.
Yeah.
So it was pretty funny. My realtor couldn't believe it on that one. He's like, I was not expecting her to be happy about the mold-filled,
See, I think everybody is like me, right? So I walk into that, and I'm like, and they're like, oh, man, it stinks in here. I go, yeah, it stinks like money.
Yeah.
Yeah.
Yeah, absolutely. Absolutely.
Yeah. I always tell people, they're like, oh, Mark, what do you want? I go, fire damaged, mold, crackheads,
cat piss,
cat piss, dog shit.
Yeah.
I tell the story. I still have the building in Hamilton, but I bought a 19 unit, and like the first day I took over, one of the crackheads didn't like the other crackhead that was living in the building, so they literally shit on their door, like shit on it, not like at the bottom,
right,
but on it. And I'm like, I'm just sitting there like,
How?
And I'm laughing. I'm like, but how? Like physically, like let's put some cameras up so we can see this stuff next time. Like let's just.
Maybe that's a new YouTube channel for you.
Maybe that's a new yeah. There you go. All right. So what does Kyle Ford say to the new investor that comes to him as a mortgage broker? What are you telling people today? Like, yeah, obviously you're still investing.
Yeah. Amazing question. And so I always. The first thing I got to do with anybody is identify their investor profile. So are we talking to a 22-year-old hustler, or are we talking to a 50-year-old couple who's doing okay? They're just looking to make some smarter decisions.
Yeah.
So if I'm talking to that 22-year-old hustler who's looking to grow, the first thing I'm saying is you need to start an actual business. You can't just buy property.
I just buy property.
To break through at that with nothing, without the background and the reputation that somebody like yourself might have now, they got to create a business.
Yeah.
And the business can just be buying properties.
Okay. Yeah.
Like that can just be the business, but you need to have a brand. You need to be adding value to people. You need to be, creating something that's investable in, because you're not going to be able to save your way to buying properties. You're going to need investors, and you got to be credible. So I also encourage them to start some level of earned income strategy. I'll give you one of my, not so much of a secret, I'm telling everybody, because everyone says I want to be a realtor, I want to be a mortgage broker. What I'm encouraging more people now to is an appraiser. Yeah. There's major demand for appraisers, and it's a good way to get a lot of insight knowledge and get paid to learn.
Yeah.
So not a bad little one. property management. I did it's. Yeah, I know. I see the look on your face.
Yeah.
But if you're,
it's my least favorite thing about properties.
But if I'm talking to that 22-year-old hustler, that's a good way to start meeting landlords. That's a good way to start learning. That's a good now value add proposition, so you can taking on money partners, and actually get paid a fee out of the deal right away.
Yep, that's true.
Now you have a credible brand and business to start attracting more money. So my advice to them is start a business at all the time. The other advice that's changed over the last 5 years, or maybe 3 years even, it used to be kind of like, just get in. Just buy anything. Get in. Get an equity stake. Get in. Now, it's not necessarily about that. I would rather see them build a business, build a brand. They don't need to rush to buy properties. The crazy appreciation is over.
Yep.
So it's not like they're chasing the needle, if you will. So I'm certainly encouraging them to still house hack if they're going to get in, buy a multi, live with a buddy. If you buy a triplex with 3 2-bedrooms, live in a 2-bedroom and rent the other room to a buddy.
Or rent all the rooms to your buddies and whatever. But
yeah, exactly. So anything like that. Now, when I'm talking to let's say that more 50 plus couple who, they got some money in their RSPs, they got some equity in their home, they got decent jobs, 5+ years to retirement, but they're running those retirement numbers and they're not happy. So with those folks, I have the same answer all the time. The best return is in properties.
Yep.
But it is the purest form of cash flow is in private lending.
Yes.
No tenants, no toilets, no termites.
Yeah.
It used to be called mailbox money, but we direct deposit now. So for those people, they really need to be looking at their ROI on these properties, because I see a lot of them buying crappy properties that really don't make sense.
Yep.
And if they just lent their money, they would probably get a better rate of return over a longer term. And I believe properties are better.
Yeah.
But if you're buying crappy ones, if you're buying a condo that's negative $500 a month,
yes,
with a bad board where your fees are going to go up, it's not that great of a deal.
That's true.
And the challenge is those people then are getting turned off from real estate.
Yeah.
Because they bought a bad deal. So I do believe in buying. I think this is a buy time. I think we can make money buying, but we can't be buying anything. The numbers have to work.
Numbers do have to work, and obviously there's room for negotiation. It's funny that I had Jake on my team, who you saw coming in, and we were just running numbers on deals. It's the video before this one, and it's like, what could I offer on this, right? Like, it's a $600,000 unrenovated that's been legally duplex on the mountain in Hamilton. And we're like, what they're asking 600, but they're holding back offers. Conceivably, what could we pay for this to make it worthwhile? And we're just dumbing that down, right? And it's like, every property can be a deal at the right number.
Yeah, absolutely.
Yeah. And then I always tell people, at least in Ontario, that, most of your property that you're going to buy here is going to be for net worth.
Mm-hmm.
I like value add stuff as well. So if you can get a sliver of land and turn that into a unit, if you can renovate it, do whatever, upgrade it, get tenants out to increase rents, whatever that is, it's going to help you increase value. But it's going to be a net worth play in Ontario.
Yep.
You got to go outside of Ontario if you want cash flow in real estate.
Yeah.
It's just how it's going to work. But yeah, pure cash play, if they're not looking to increase their net worth, then private lending is probably where it's at.
Absolutely. In Ontario, what I always say is cash flow is required to maintain. But when people go to these real estate type events, they're like, well, if I get 5 or 10 duplexes that cash flow at $500 a month, I'll make $5,000 and I can quit my job.
Yeah.
Really not how it works.
Well, those were my numbers in early 2000.
Yeah.
But they were not. They worked back then. But even then, it didn't work.
You likely can't take that $500 out of the account. It's
Yeah.
really got to stay there even though you're budgeting for expenses, you got to keep it in.
Yeah.
So in Ontario, what I'm more looking for on my value add plays is, even if I cash flow $1,000 a month on a building, I'm not taking that out. It's staying in the account. I'm looking for the net worth, the lift.
Yeah.
The lift on that increasing net worth, and the cash flow is my lifeline. It's my protector.
Yeah.
That means I'm good. I don't need to work to pay for this, and it's going to protect my net worth that I've increased in the deal.
Yeah.
So,
and sometimes you pull that money out anyways on a refinance, right?
That's right. That's right. So, and that's where most people are retiring on. They're not retiring on the cash flow. They're retiring on a sale or a refi.
They're eating their equity.
Yeah, and then they get a $500K refi. They put $100 in the account, so they're good for a little bit, and then they lend $400.
Yep.
And now they got some 2 or 3 years. Maybe they take another 50 out, keep the 350 lent.
Just arbitrage.
So exactly.
Yeah.
So
Good. All right. Is there anything else you want to share with everyone before we sign off?
You know, in today's real estate market, there's so much fear. Right, there's so much people being scared into sitting and doing nothing, and that's really not the answer. The answer is not cowboy slinging, buy everything, but negotiate, ask for deals, make offers. VTBs are back in a big way on multifamily. The sellers know that if they want their price, they got to hold financing. So don't be scared to ask for that. The other thing that I would say that I think is super important in today's real estate market is around exit strategy. There's what you want to do and what you need to do. And I want to hold a lot of my properties.
Yep.
I want to, have a high door count. Not particularly, but it would be nice to have more doors.
Yeah.
But at the end of a deal, if it doesn't make sense and my return on an equity is not great.
Your ROE. Most people don't do ROE, by the way.
And it is the most crucial thing.
I'm an equity investor. That's what I'm looking for. Always ROE.
ROE, most people don't even know how to run the calculation. And what you put into the cash you put into the deal at the beginning is irrelevant. It's the equity position at the time of analysis.
Yeah, and comment down below. Should I redo that video? Because I did that video a long time ago. It must be 2 years now. So comment down below if you think I should redo that video.
I'm gonna get on here and comment.
All right.
Because absolutely you should. It's so important. But at the end of the day, well, the way I now analyze a deal right now is when I'm doing a value add apartment building, I want to keep it at the end, but I'm totally okay selling it too.
Yeah.
It doesn't really matter to me. It's cold.
Well, you're indifferent. Like I got an 84 unit apartment building in Alberta, and I've ran the numbers and I know what my exit is and I know all that. But if somebody comes to me after and says, here's an extra $1 million, I'd be like, okay,
sure.
See ya. Thanks.
It's numbers on a balance sheet.
Yeah.
Right. And that is the cool thing about the multifamily stuff. When I got into the cottages, at most I had 14 cottages. And when I say cottages, like these are pretty nice homes. And there was you get a little emotional about them. You like it. You spend a weekend at one, and it's hard to sell, and it's hard to look at it critically and say, this asset isn't performing as well as the other ones. The other really important thing, and it's a strategy I've preached for a couple of years, and these are for your 10 plus property owners. I call it sell the dog.
Yeah.
And if you have 10 properties, there is one property in that portfolio every year that is performing under the other 9. You need to sell it. Because what happens as you grow and scale your portfolio is at some point, what's your exit? What's your overall exit?
Yeah.
And it could actually happen to you where you have so many properties and a tax burden of selling them all at once that it becomes a problem. So you need to be selling the dog, the underperforming property, on an annual basis, calculating your ROE. That's generally how you're going to figure out what the dog is.
Yep.
And moving that money into a better performing asset that's more at the top of your portfolio.
For sure. Good stuff. All right, Kyle Ford, thank you so much. Guys, if you've made it to this point in the video, you've gotten an MBA. So make sure you smash that like button for the YouTube algorithm. Comment down below. Make sure you follow Kyle on Instagram. He posts a lot of good shit there. And we'll see you next time.